Good afternoon, everyone. Thank you for joining us for the latest in our regular webinars, looking at the outlook for investment markets for the year ahead. I'm delighted to be joined on the call again today by Lothar Mentel. As some of you will know, Lothar is the Chief Executive and Chief Investment Officer of one of our closest partners, Tatton Investment Management. Lothar co-founded Tatton in 2012 and since then has overseen its growth to become one of the leading discretionary fund managers in the UK, managing over £25 billion of assets, including several hundred millions of assets for SG Wealth Management's clients. I'm hoping Lothar is going to turn his camera on and say hello to us. Here
Hello,
he is.
hello.
Hi,
Am I
Lothar. Thanks
hearing?
for joining us. Um, I've got a few slides just to go through before we start. Firstly, before we move on, just a bit of housekeeping. We do have a question and answer session planned for the end of today's presentation. Please feel free to submit questions during the presentation. You should have the functionality to do so during on your Zoom console. So yeah, before I hand over to Lothar, I have a few slides just to set the scene. Firstly, for those on the call that may be new to SG Wealth, this slide summarises who we are, an award-winning East Anglian-based financial planning firm. Whenever I share this slide with our clients, the first thing I point out is our independence. We are a privately owned firm, owned by the management of the company, and being directly regulated by the FCA and with no overarching owners telling us what we can and can't do, we can select who we feel are truly the best partners to work with in delivering solutions to our clients. And that includes, of course, our friends at Tatton. This approach has stood us in very good stead for the last 25 years. We celebrate our 25th anniversary this year, and we believe it will do so for many, many years to come. Just quickly flash this slide up. My compliance team would not forgive me if I didn't share it at the start of the session. I won't read it all out to you, but essentially it says that what you'll hear today are our current views, but not to treat anything you hear as personalised financial advice. This will always be delivered by your individual financial planning contacts, and you should not act upon anything you hear today without consulting your financial planner first. So we last hosted a webinar with Lothar in January last year, a week after Trump's inauguration, and it's been a very busy and to say the least unpredictable year for the global economy since then. We put today's date in the diary some months ago, and the brief we gave Lothar was to look back and review the last year and how Tatton had helped deliver excellent investment returns to our clients, and then to look ahead as to what the global economy and markets may have in store. That does remain the agenda for today. However, of course, the events in the Middle East over the last fortnight will be a key focus of this. At times like this, our job is to look unemotionally and rationally at the economic impact of geopolitical events. But before we do, I must pause to say that the importance of the economic impact pales into insignificance compared to the impact on families and communities who are personally affected by injury, loss of life, loss of homes, and all other impacts of humanity in all affected countries. Our thoughts and prayers go out to all innocent victims of conflict and war, and first and foremost, we hope for a peaceful resolution from a human perspective. With that said, however, turning to investment markets, the reaction over the last couple of weeks has actually been relatively muted, given the dramatic scenes and headlines we've seen in the news. This slide shows the return from various markets since the start of the conflict a couple of weeks ago, up until yesterday's close. You can see the sharp rise in oil prices in pink, albeit with the fall back to around $80 to $90 a barrel, that sort of range after Trump's speech on Monday evening. The other lines on the chart show returns from global equities and UK government bonds, and whilst they are all negative, they are not severely so. The S&P 500 in the States was down only 1.5%, whilst the falls in the UK were slightly more significant, but not hugely dramatic, falling by around 5%. Emerging markets have been some of the most volatile areas over the last couple of weeks. However, the MSCI Emerging Markets Index was only down also around 5% over the period. This sort of volatility itself is not uncommon in markets, even in peaceful times. We appreciate that even limited market falls can be unsettling, particularly in times of troubling geopolitical news flow. But it's also worth considering the recent volatility in the context of equity type returns over the last 12 months. This chart has now been expanded out over that 12-month period, and it shows that the last couple of weeks have simply taken a little cream off the top of what have been excellent returns over the last year, with emerging markets still returning 35% and both UK and US equities up over 20% until the middle of this week. So, the material impact on the economy will clearly depend upon how long the conflict lasts, and importantly, how long the oil supply is disrupted. As the chart on the right of this slide shows, Iran itself is only responsible for around 4% of global oil production, but more significantly, around 20% of global supply is dependent on export by the Strait of Hormuz. Therefore, as we all know, all regions of the world, including the US, are affected by the current disruption, and all have a vested interest in seeing these supply issues resolved quickly. Of course, the fear is that prolonged disruption leads to materially higher oil prices for longer, and that would lead to higher inflationary expectations around the world. Already, what we've seen is that expectations for interest rate cuts this year that were already priced in at the start of the year are now starting to be priced out by traders, as the charts above show. That said, many of the economists that we listen to currently suggest that hopefully the inflationary impact will be much shorter this time round when compared to, say, the post-COVID Ukraine war shock of 2022. And therefore, we will not see too much impact on global growth forecasts for this year. I'll let Lothar share his more detailed thoughts on this shortly. Before we do, I've got one final slide before I hand over. We often share this with clients in times of geopolitical shocks. This chart shows the subsequent 1 year and 3 year returns from immediately before a variety of previous market shocks dating back to the First Gulf War. The return represents the excess return generated over and above cash during that period. And it should reassure you that at times like this, the best action to take really is inaction itself, and to trust in your financial plan and its long-term investment strategy, rather than trying to react at a time of crisis. That said, active portfolio managers can tilt portfolios to take advantage of volatility, and our friends at Tatton have a very good history of getting their tactical investment decisions right. So I think that sets the scene hopefully nicely for Lothar, and I'll hand over to him now for his thoughts.
Thank you. Thank you very much, Henry. And yeah, thank you very much for having me again on your client seminar. We are incredibly grateful and thank you for giving us your trust with your clients' money. We don't take that lightly. We hope to be living up to your expectations. And it's also good that we did a presentation last year, because we can, I suppose, reflect back to some of the things that I said then to see how it all came out. Well, obviously, it's a slightly rude cartoon, but let's just say that at the moment, the global economy is hoping that Don isn't going to mess up a relatively benign environment that we entered at the beginning of the year. The things that mattered until 2 weeks ago actually still matter more than we might think at the moment. So markets are at the moment driven less by the oil price than by some other things that are forming some headwinds that we didn't have at the beginning of the year. And we'll have to see how we get through this. But for the time being, let me just say, AI is at the moment still far more important to markets and what it may do over the medium term than the current oil price, although that could change. If we look at the next slide, it's very much similar to what we just saw from Henry, which is just showing what the market performance was after an oil shock. We can see there's one massive outlier in there. Everything is just as Henry said, but the Yom Kippur War in 1973 did cause or was the precursor to a very significant bear market and caused a global recession. Oil shocks can do that. If you get a massive energy price shock, that can throw the global economy into a recession. Uh, it's just that that only happens if the fundamentals of oil supply change. And back then, for those of you who can remember, it was a general swing of OPEC against all the Western world, reducing oil output towards them, whereas there's no sign of that at the moment. Indeed, we've got very clear voices from them saying, no, we will expand production outside the Strait of Hormuz. And yes, while there's 20% of the oil going through the Strait of Hormuz normally, there are also various pipelines that can carry about 10% of the oil output. And we entered this war with a oversupply situation anyway on oil, and therefore that might explain some of the relatively benign market reaction. Although we obviously did have and still have a reaction that has brought the oil price up a good 30, sometimes 40%, which is very much driven by it being quite difficult to read the different dynamics that we have, predominantly how long this war and this conflict will take. Those who are looking more optimistically in the future would argue that Donald Trump gets bored very, very quickly when he doesn't get a massive success like in Venezuela. So we've already heard him say that he's already won the war, when maybe observationally we would say we can't quite see that. But so it is quite possible that this whole affair is over relatively quickly. And then we need to recognize that Iran doesn't really have any incentive, and not even the Revolutionary Guards, of continuing to terrorize their neighbors, because they also need to sell oil. If they can't sell oil, their economy very quickly falters because they are very much dependent on that revenue. But so with this, just upfront, we'll go into more detail a bit later. Let's look back at where we've come from and where we are at the moment, just in order to get the bigger picture. It's not all about oil, as I said. So on the next slide, we can just see, as usual, the long-term returns from the main asset classes around the world, going back to 1987. And while UK equities recently have made a really good return spurt upwards, having been subdued really compared to other markets since the Brexit, it is still the US markets that have really dominated returns over the last 15 years. Whether that continues is very much the question at the moment in the debate and the discussion, and we'll look at that in a minute. But the other point that you can probably make out there is that gold has all of a sudden spiked up. You will have heard it anyway, but even over that long time period, it looks like it's outperforming gilts, property, anything else but equities. And I'm pretty sure some people think, wish I was invested in gold. And we'll have a look at what gold does to portfolios, or not for that matter, towards the end of the year, and why we are happy not to be holders of gold in your portfolios, because we do not believe it produces a consistent return path over time with which you can fight the onslaught of, or the undermining character of inflation. I've got some slides towards the end of the deck. If we go to the next slide, I think I introduced that already last year. So I know that people always are a bit fearful when they see, like on the previous slide, return graphs going almost hyperbolic. But that's just the nature of compounding. Even when you compound a 7% per year return, eventually a proportional chart goes like that. That's why we translate long-term returns, prefer to look at them in a logarithmic chart, which basically just translated translated into ongoing growth rates. And from there, you can read whether things are sort of out of kilter or in line with the long-term return trends. And so the black line here is global equity markets. The blue line is US markets. And we've added that compared to my presentation last year, just because there's so much discussion at the moment about the US being desperately overvalued and really the end is near and all of that, which is perhaps not quite the case. I mean, we can see that, yes, it's bumping at the upper end of its long-term trend channel, and it is certainly valuation-wise and long-term return-wise above what we've seen for the rest of the world. But then there are at the moment also good reasons, given that a lot of the things that we use, including what we use right now to do this webinar and the computers we're sitting on, a lot of that, most of that technology originates from the US. Not that it is a reflection of the US economy as such. It's just that those companies are domiciled in the US and therefore drive their stock markets there. So over the longer term, we are perhaps mindful of this, but not hugely concerned. But nevertheless, there is, if you like, a elephant in the room. So if we turn to the next slide, which is well, maybe go. You've given my given it away already.
There you go. Sorry.
So what this slide shows is on the x-axis where current equity valuations are. And in the investment world, we always look at multiples of corporate profits or earnings as what the share price currently is at. And then on the y-axis, you can see what the next 10-year annualized returns have been. So if the PE ratio, the price earnings ratio, was around 14, then investors usually experienced annualized returns of around 10% for the next 10 years. Whereas if those valuations were quite extended, i.e. in the 20s, then the next 10 years tended to be not so great. So that kind of is a fairly damning verdict at the moment on the US market. But if we now go to the next little panel there, it doesn't unfortunately tell you anything about just the next year ahead. So even at those very high levels, the next year can be very positive, can be very negative. It doesn't tell you very much at all. And what we need to recognize is that that green bar can move not just because of the price, but also because of the earnings and the earnings growing, because it's the PE ratio, i.e. price divided by earnings. If the earnings go up, the PE ratio goes down. So if we now flick to the next slide, which is just an update of the previous slide. So the previous slide I drew on 14th of January, and now at the current level, markets have come down somewhat, but as we saw early on, and we'll see later, the US has more or less gone sideways, but earnings continue to grow. And they're growing at a very healthy tech of 20 to 30%, depending on company. And therefore, all of a sudden, these things can change very quickly. And while we're still not looking like at exciting market return levels historically, 5%, this could again change quite quickly and move further to the left. Sorry about that. Bit of a seasonal cold. So moving on then, looking back to last year, it really wasn't the year for the bears, and the bulls had the upper hand again, and we can see that already on the next slide. Sorry, I've got a cat that does like to visit me here. So these are the market returns for since the beginning of 2025, and as you can see, the world ex-UK, ex-US has for once really led the US. The US has not been the strong performance. I mean, it performed, but in GBP terms, actually only around 9%, whereas the rest of the world gave you, well, now looking back from where we are, 28, but it was up to 40% until this oil shock happened. So the dominance of the US seemed to have been broken last year, And the question is very much, will that carry on, or is that very much a result of what Donald Trump is doing at the moment? Is it going to undermine the US prowess in stock markets? And while there are some long-term question marks around whether the US can maintain its position if it continues to undermine the intellectual capital built through its universities, for example, those things take far longer. And at the moment, it's more a result of the US dollar external value bearing the brunt of the eclectic or the eccentric geopolitical actions that the Trump administration has taken. And in terms of earnings, they have still been dominating the rest of the world. It's just that they went into this period with far higher valuation levels than the rest of the world. So really, the rest of the world has just caught up as investors were looking around and trying to see whether there was an alternative to just piling everything into the US, which, as we know, is never a good idea. Diversification is really what drives reliable and consistent long-term investment returns. If we now look at the next slide with the returns just now, very similar to what we saw earlier from Henry. So the US has not really gone anywhere particularly, and interestingly, if you like, has been the big winner of this war period of the last two weeks. So their stock markets haven't really fallen particularly much, which kind of makes sense against the backdrop that they are these days energy self-sufficient. They're exporters of oil, not importers. Nevertheless, the global oil price still also reflects into the US market. So if Donald sees that the gas price at the pump remains in the $5 to $6 era, he can probably make the calculation that he's not going to do so well in the midterms, which is very much his focus at the moment and seems to be driving everything that he's doing. We've seen a marked decline in the Far East Asian markets, particularly emerging markets, but also Japan. But that came against the backdrop of a very strong rally. And as you can see on this chart, even now, they haven't even fallen back to where they started the year. So still looks fairly strong. Whether that continues or not will very much depend on how long that blockade of the Strait of Hormuz will continue, and therefore for how long we will have elevated oil prices. But as the next chart shows, or table, or whatever you want to call it, it's a patchwork quilt over the years of which market is ahead and which markets are perhaps behind. Although, as I said, over a 10-year horizon, the US markets have done extremely well, but the range changes every year, and therefore having a diversified portfolios as we run them for you, I believe make imminent and a lot of sense. If we now look at where on the next slide where stock markets are trading at the moment in relative valuations. So this chart shows you the different regions. The gray box tells you the range in which valuations have been between the 25th and 75th percentile over the last, I think that's 25 years. The green bar tells you the long-term average, and the little diamond tells you where they are at the moment. So obviously, things look like they're trading on a discount if that blue diamond is below the green bar. And we can see it's not below the green bar anywhere. They already have come down somewhat. I showed you the slide early on, the chart in the US. They were trading definitely above 22 early on in the year. Now they're getting closer to 20 because earnings are growing into the bigger shoes of the price. But nevertheless, this makes markets nervous and also explains why we need to expect market volatility this year on any suggestion that perhaps what's currently priced in may not happen. And what's currently priced in is quite a positive economic outlook with which we started the year. And perhaps there are now a few more headwinds, and therefore it may not be looking quite so sustainable anymore, although I would say these valuations are against the backdrop of the very strong earnings growth that we still have, not something that get us particularly worried about a market downturn, although earnings need to continue to grow in order to justify these valuations. Now, the one big undermining factor we had over the last couple of years was inflation. We had that big inflation surge. If you look at that, yes, we're well beyond that yet now. We might not be entirely out of it compared to where we normally like to be. But the more important takeaway from this is that it's clearly something that the central bankers around the world are very unhappy about that this happened, that they were too slow to react to that inflationary surge that we had in the combination of the post-pandemic boom and the fiscal looseness that came from particularly from the US government. And therefore, what we can take away from this is that if inflation was to rear its ugly head again, you can be very certain that central banks will react a lot quicker. Hence, also why you might have read yesterday the European Central Bank saying, "Oh dear, if the oil price goes up, we'll raise interest rates." Which, as an economist, you would say that's probably the least intelligent thing you could suggest. That when the economy goes into a bit of a crisis, that you punish it even more by raising interest rates. But that's where this is coming from. And they're just basically sending out a warning message to the public and every company to be mindful not to use this for major price rises because it will come back to haunt you. Now, if inflation is one element that is driving valuations just simply because it's the projecting the level of yields and interest rates and therefore creates, if you like, a competition to equities. Equity prices are, as we said, very much driven by growth. And on the next slide, we can see how in the left panel, economic growth around the world is projected to remain fairly positive. And that's not just for this year, it's also for 2027. And that is what drives that relatively positive outlook that we currently have. I would not quite subscribe to what Elon Musk said there, and we quoted at the top that we get to double digits or even triple digit growth rates. That's just Elon Musk being Elon Musk. But it is certainly correct to say that we are currently, with the introduction of new technologies like artificial intelligence in particular, seeing a significant increase in productivity, particularly in the service sector, which we have not had for 15 years, and that is providing a strong growth catalyst. So on the right-hand side, we then see across different regions the growth rates for last year and the projected growth rates going forward. And there we can see that actually Europe, emerging markets, China made some very strong gains last year in the stock markets without having had anywhere nearly as strong earnings growth as the US. And indeed, this year, only emerging markets were at this point, and this might change, seen as generating better earnings growth, corporate profits than the US. This is not saying that one should therefore put all their eggs into the US basket. It's just saying let's not throw the baby out with the bathwater either, because the growth is still there. And at the end of the day, it is the facts of the underlying earnings which underpin share prices and stock market valuations. And that is worth keeping in mind. And it's already come back to us. We've seen it over the last 2 weeks. Those that were particularly overweight towards Asia and emerging markets got a bit of a bloody nose, as really the US has once again done the best in this environment, also because their earnings momentum and their economic momentum seems most solid despite anything that Trump seems to be throwing at it. So this is what it currently looks like. Carrying on then to what your portfolio returns look like. I was not as optimistic at this point last year as the returns have come out. You can see here that we have got returns anywhere between 9 and 19%. for the 12-month period, despite the drawdown that we recently had, which I have to admit, is also driven by the fact that last year markets also suffered quite a significant drawdown. As you remember, during March, the fear of Trump's tariffs started and the markets would take a hit, and it all culminated then in the Liberation Day announcements around tariffs. So for the next couple of weeks, even if stock markets start, continuing to be weak, 1 year returns will still look quite positive. It's just after that we would need to see a recovery in order for this year's return to stay as positive as last year. If we turn to the next slide, which gives you the 3-year returns, you can see that it's still quite pleasing with even the balanced portfolio being close to 10% annualized. So this is not a 3-year return. This is the annualized 3-year return. So and you probably know from your advisors that even a 7% return doubles your money in 10 years. So these sort of returns are very strong and good news for clients who are saving up for their retirement or are in retirement and are looking at how long their money will last into retirement. Also importantly, I've, as always, got the two baselines at the bottom. The yellow line is what you can earn in a no-risk money market portfolio, i.e., these money market portfolios can and have historically tracked the Bank of England interest rate as they set them, and below that you've got where inflation is at the moment, and that those two lines are obviously the very minimum of what you want to beat over the longer term, which is why I also show the next chart, which I think my industry at the moment is not that keen to show all the time, which is that over 5 years, actually, inflation has been quite an issue and problem, even for investment portfolios, and you haven't necessarily seen a distinct outperformance of inflation for anything above or below cautious. And why am I showing this chart? Well, simply to also point out that there is a risk of low risk investing. So the risk that particularly low risk investors, those who think that they want to keep their portfolios from gyrating wildly up and down, also risk underperforming inflation over the longer term. And that needs to be kept in mind, even though this is an aberration that we don't think will repeat itself anytime soon. I spoke about how the central banks will be paying much, much closer attention, but thereby also might be bringing down some of the growth rates because they might raise interest rates earlier than they should. But the next slide, which gives you the 10-year horizon, is really how we would expect it to be. Sort of balanced returns being about at least or around 4 or 5% above the rate of inflation, and global equity portfolios easily being able to reach 7% annualized above the rate of inflation, which is exactly what our portfolios have generated. So how did we get to these results? Well, so in terms of positioning, we can move to the next slide. We always like to steer a steady ship. Yes, we have got tactical discretion moving the portfolios into this or that direction, but we're certainly not a hedge fund who is trying to second guess what's going to be ahead. We operate with a wide diversification across asset classes, regions, and then underlying instruments, because what we want to generate first and foremost for you is reliable long-term returns. We know that if you manage to shoot the lights out because you've made some good bets in 1 year, it can very much go against you very shortly thereafter. And we're observing exactly that right now. The first 2 months of this year saw some stellar outperformance by some investment managers who had put a lot of investment into the Far East, into emerging markets, and really drawn down on what they hold in the US, only for that to come to haunt them over the last 2 or 3 weeks. And therefore, we believe moving portfolios more gradually to the trend is really what you want to do. That being said, we have and did underweight the US last year compared to the long-term allocations that we normally have to them. we overweighted Japan, we overweighted Europe, and more recently, we overweighted the UK and emerging markets a bit more. But in this sense, when you are more neutral on the overall mix between equities, bonds, cash, and alternatives, if you then underweight one a region, you have to overweight another, and that's exactly what that shows you. Although we did have a strong call on Japan and now also Europe. On the bond side, there was a bit less to play this time around. There wasn't quite as much movement as we had in 2024, so less opportunity for us to eke out some extra gain. But really, last year, it was less about moving tactically very strongly, and it was more about keeping a level head and adjusting the overlay funds in particular, where we can move far more swiftly over the shorter term. And therefore, on the next slide, we see I always like to reflect on the hits and the regrets that any fund manager will always have. That on average, having been more or less fully invested over the course of the year was what paid off, particularly learning that Trump isn't, well, he is a bit of an eccentric character, but he's still under the control, if you like, of the bond markets. If the bond markets give him a hard time with ever rising yields, he will come down from his maximist demands, and that's what's become known as the taco trade. Trump always chickens out, coined by a columnist in the Financial Times, Rob Armstrong, that we follow and read, and he's still alive, which is very good to hear, despite getting Trump really irate over that term. But overall, yeah, I'm happy with the moves that we have made. We are slowly moving portfolios around, tilting them to the trend, if you like. And one of the major tilts that's underway at the moment is that actually you don't need the absolute return fund managers quite as much anymore as you did when you couldn't get any meaningful yield from bond investments. So the bond yields now allow us to balance portfolios more evenly. Again, we don't need too much of the absolute return fund managers anymore, who tend to have a hard time when the markets are trending in one or the other direction. So you might have seen in the press that we have started to take some of those absolute return funds out of the portfolios and replace them by bond and credit portfolios. Moving on to the next slide, then, comparing our returns against our competition. It's pleasing to see that peer group of the ARC UK wealth managers hasn't been able to generate quite the same returns that we have on platform. But I'm also, happy to see that it's not been absolutely silly amounts, because that usually means that you're taking more risk than the others, and we don't believe we've done that. So the flood of green here, which shows you the performance in excess of what the peer group has generated, is exactly where I want to be. And pleasing as it is, I won't be able to always produce that for the 1, 3, 6 month, even for the 1 year. These things can turn the other way if something just marches ahead for a short period of time before reverting to the mean. I have also included our ethical portfolio returns. I don't know how many clients are in that, but just to show that if you restrict the investment universe, which ethical does, you're not choosing from the whole global universe of investment opportunities anymore. It can get a little bit more choppy. They are more growth orientated because ESG and ethical investments usually are around things that are expected to do well in the future over the longer term. And therefore, this growthy character has been at their slight detriment over the shorter term, as we've seen, at least before the start of the Iran war, a rotation from growth into value. Now, just like with Henry, we also have to show a compliance slide, which is the next one, just to say this is the basis on which we calculate these things. But It was also last year pleasing to see that even the press has picked up on the consistency of returns that we generate across the industry. We're not always for all time periods the very top, neither would I want to, but we are up there, and that's exactly the consistency of returns that I want to generate. Um, I did sometimes hear in the press out there or from competitors that our strong performance must be surely just because we have massively overweighted the US and the Mag 7 stocks that were leading the markets for so long. And quite frankly, last year would have been the it would have proven that didn't work. And so we still produce, as you can see here, strong returns. And on the next slide, we're also showing that no, we were underweight. We produced the strong performance through a diversified portfolio and being invested in many different things, including the Mag 7, but not putting all the eggs in that one basket, while recognizing it is where a lot of the growth is coming from at the moment. So that's the sort of looking back. Let's now turn to the looking forward. And if you think that picture seems familiar, you're absolutely right. I had exactly the same one last year, not because I've been too lazy to update my slides, but it's because it applies today as much as it applied last year. Last year was very much on, oh my God, what will Trump do? Either the Edward Monk, the Scream, or the more thoughtful Ronin type thinker investors, which we like to think we are. This year, it's very much more on the investment outlook that we entered the year with. So we seem to have a bifurcation that I haven't seen for many, many years, where it was either on the back of an AI-driven industrial revolution, everything up to the moon. We saw the Elon Musk quote earlier, or on the back of, oh, we've had 3 strong years and actually Bitcoin has collapsed and the Mag 7 aren't giving me the returns anymore. Everything is going hell in a handcart. Now, as I said, we are more the thinking type investment managers, and therefore we accept that things usually aren't quite as extreme as the one side or the other. So neither to the moon nor hell in a handcart, but somewhere in between. And over time, things can vary a little bit in one or the other direction. But I thought at this point, it's good to look back what I presented to you as an outlook last year. So as I said, prudence suggests single-digit 2025 returns at best. Well, I'm glad I got that one wrong. But obviously, in the midst of the post-Liberation Day market crash, a lot of people thought they were going to get a negative year, let alone a positive year. But as it turns out, what we were thinking was probably right. The short-term risks that we listed, Trump overdoes it. Yep, well, he did. Valuation headwinds in the US from higher yields, that luckily did not play out. Instead, we had actually valuation tailwinds from ever stronger earnings growth. But the portfolio return potential was right regionally as we implemented in the portfolios more with a overweighting to Asia, as well as going from growth to value, which our active managers very much did in the underlying funds. And we said back then, stay clear of emotional assets like crypto and diversify beyond US mega tech and those things we implemented. Obviously, well, we never had any crypto and we never will have any crypto in our portfolio. But very clearly, anybody who invested at the height of the crypto mania last year would have lost half of their money, which would have been very regrettable. What we said then towards the end of the year on the next slide, my outlook was very much driven by the fact that actually when you have got the confluence of fiscal and monetary easing, which was very much what we started to have last year with Europe declaring that they had to invest in their infrastructure for defense rather than relying on the US. In the US, Trump administration very much hoping that they can get a better midterm result from the electorate by stuffing their pockets with tax refunds this quarter. It all requires fiscal stimulus. All the while, interest rates were going down, and we had a significant investment momentum in train as well from companies investing in AI. So yeah, not unhappy with that outlook, but the dynamics as we have them now are difficult to watch. And if we click slowly forward, so we call this our bingo card for the year, things that we were watching from the start of the year. So yes, a few ticks are appearing in those boxes, all the things that we have to watch. So we did have the US small cap outperformance. That's already stopped again. We now have the geopolitical flashpoint. Not that we were particularly expecting it to be around Iran. That has surprised us as well a little bit. But yeah, the points are coming to the fore. I said we have significant investment, not or spending, not just from governments, but very much from industry as well at the moment. And so on the next slide, that is visualized just how much the big Mag 7, although it's Mag 6 really, because Apple isn't in there. Apple doesn't do this sort of, they rely more on outsourcing. Just how many hundreds of billions are being invested in. This money is like a fiscal stimulus. It just gets economies going. Last time we had that was with the Y2K investment frenzy. You will recall back in 2000 when everybody was fearing a big meltdown. So we have a bigger investment boost now, and that is and has to be positive for the economy. Whether everybody will be a winner from it, that's at the moment very much the question. But the economy overall is always a winner from more investment, which we were so much lacking over the last 15 years. So that's a very much a positive. Although it does also come with a negative, because all these companies are currently, or apart from Oracle perhaps, are paying for this out of their free cash flow. And previously they used their free cash flow because they didn't have any particular investment targets to pay it back to their investors. So on the next slide, we see how their market cap, their market value was very much in line with what they did in share buybacks. And those are the blue bars. And since last year, there's a gap between the blue bars and the net income. So that gap between the red line and the blue bars is what they're now pumping into investments in data centers and so forth. And while their market cap was initially still rising, as of late, it's obviously come back somewhat. And we may see that just because of that, the big megatech companies may not be the overall market winners and only really grow proportional to their earnings growth, rather than getting higher valuation all the time from through their share buybacks. So that's one of the liquidity-driven assumptions and observations we need to be aware of. We always look at the economy also from the sentiment across industry. So on the next slide, we see how the PMIs, they're called, they're the purchasing manager indices, basically a survey of businesses that historically have proven to be a good early indicator for where the economy is going. They're all at the moment above 50. 50 is the demarcation line between contraction and expansion. And that's really where we entered the year on a very positive. I would expect those in this quarter to come down somewhat, but at the moment they're still in a good place. On the next slide, we have again the what I already showed you, that the valuations are quite high across all markets. But if we go into the markets, we see the rotation potential that's still there, and we're making use of some of that by rotating into funds that go more into the small and mid cap stocks in Europe and in the UK, because as you can see there on the right-hand panel, the high valuations aren't quite prevalent in the smaller cap sector. Now, the smaller cap sector has underperformed for a long time, and it's still probably too early to call a massive rally and recovery of that sector, but we're seeing the first signs of better performance coming back, at least in the first 2 months of the year so far. The early warning signs are always the credit markets, and the next slide shows us how credit spreads, i.e. the premium that lower quality borrowers have to pay over the government, always spike up during periods of fears of downturns or downturns. Particularly, you see they're spiking, I'm sorry, in 2020. Whereas at the moment it's still hovering around relatively low level, although it has they have spiked up recently, but only back to more average levels, which is probably what we would expect at this point in time. We have to say, however, that one of the headwinds is actually coming from the credit markets, in that private equity and private credit, are you taking it off the main markets and putting it into private funds, and has actually suffered quite a bit of a decline. That's also because they've taken a lot of what they thought was very high opportunity and low risk investments, particularly in software, into their funds, and that's performing particularly poorly recently, as everybody's trying to find out which of the software companies is going to be a winner and who is going to be a loser from AI being able to do more and more for them. So that is one to be watched, and at the moment posing a bit of a headwind in the overall economy, because it means that uh, it will be harder for some companies at the lower end of the credit spectrum to access funds and funding, and that's never that's good for the overall economy, even if there's a lot of money and funding coming top down from the investment of the hyperscalers in their data centers and all the chips and everything else in infrastructure that they're building. Now, I had promised a chart on gold, so the next one is on gold and on the very long-term gold uh, development. Now, this goes back to 1960, actually, and it is on a logarithmic scale, and it is inflation adjusted. So it's in purchasing power terms, to show you how gold has performed over the last, well, 60 years. 65 years. And what the first insight we can draw from it is that anybody who bought gold back in 1980 would have only got their value back very recently. So that's how long a drawdown of that asset class has lasted. The second bit that we can always take away from this is that whenever gold goes into a spike, buying at that point in time is usually a recipe for sitting on losses for a long time thereafter, which would also most likely apply at the moment, although we wouldn't be able to say whether, we just hover around the 5,000 now, or whether it might go up to 7,000 or even 10,000 before it's coming down, but usually it comes down. Why is that? Well, if you cast your thoughts back to the political environment, the geopolitical environment around the highs and the lows, the highs tended to be when there was a lack of trust in the US dollar and US generally bond returns for international investors and central banks. At the end of the 70s, obviously, their lack of success in Vietnam and the lasting recession in the US meant that there was not much trust in the US dollar. And then again, during the financial crisis in 2008, 2010, a lot of money again went into gold. So it seems to be very much correlated to lack of trust in the US. And so recently, once again, more and more investors are not so sure whether they can still trust the US. But once the trust returns, gold prices fall. So the low there in 2001. Unfortunately, also when Gordon Brown decided to sell most of the UK's gold, was when there was really no other nation on the planet apart from the US that was really very highly trusted. Now, in terms of the outlook, apart from just having observed that gold goes through these ups and downs, we also have to recognize that perhaps going forward, there's not just going to be the one global currency anymore, that being gold. Recently, we see more and more trade being conducted between emerging market countries or in the non-G7 bloc in Chinese renminbi. So if investors are starting to see the renminbi also as another reserve currency, then this whole idea that gold is all dependent on trust in the US may also go away. And if central banks are starting to allocate more money to the renminbi, as they currently already are, they could kick off a momentum trade in the other direction. Momentum just meaning it goes in one direction or the other, just because it is going strongly in that direction, because you can't actually value gold like other asset classes, because it's a non-yielding asset. Indeed, it's a negative yielding assets because you have got storage costs. So that's just a little bit on gold for anybody who's getting overly excited about gold. Really treat it as a high risk asset rather than a low risk asset, and one that you might have to pass on through generations for you to actually see a positive return. Which leads to the last slide, which is actually not that much of a surprise, probably after everything that I've said. So markets are set for growth, but the oil shock could slow progress. And we also have now the headwinds of credit wobbles. It's a bit of a credit crunch in the private credit area. That isn't anything systemically like an undermining of banks because it's outside the banking sector, but it might still mean that certain parts of the economy aren't having as ready access to capital as they had up to this point. So compared to where we were at the beginning of the year, it is still a pretty positive outlook in terms of the economic momentum that we have around the world. But if this oil shock persists for more than just a couple of weeks, which is not currently priced in, then that could bring growth rates down by up to 1%. Now, 1% lower growth rate globally isn't a recession, but it would mean that my prediction of last year that we would be happy with single-digit returns would be very much true again this year. And then the winners and the losers of the AI revolution is also something that will have to play out. At the moment, we know that for the economy overall, the increase and the improvement in productivity is a very, very positive thing. But who the winners and the losers are underneath is very much the question. If you cast your thoughts back to 2000, I think everybody expected that Yahoo would be the big search engine of the future, and nobody was really using Google. And these days, Google is one of the Mag 7, and nobody speaks of Yahoo anymore. So this is just to say you want to continue to be invested in a very much diversified portfolio where you're not overly exposed to the one or the other, but participate in the general upswing. Now, I had hoped that I would be able to get through these slides a bit quicker than I did. Apologies for that. But yeah, that's the end of my remarks here. And back to you, Henry. Any questions so far?
Yes, thanks, Lothar, and yeah, thanks for your time at a busy time over the last weeks, and clearly with a bit of a cold like I have as well, giving a nice detailed presentation is always a bit of a struggle. So thank you for that. But we do have a couple more questions that have come in, if that's okay.
Please.
I will try and wrap them up together, actually. I mean, quite a lot of them are obviously looking at sort of what's going on at the moment in the Middle East and thinking about, what your thoughts are in that regard. We've had a question about actually, funny enough, the taco trade, which you mentioned, and it sort of said, do you think that markets are currently underestimating the potential for significant long-term shock because of the war, because of the taco trade, and the fact that everyone thinks that Trump will chicken out, but actually that may not come to pass. Indeed, I guess to add to that, from my perspective, he's not the only actor now in that conflict as well. And then trying to morph that into a second question, I guess, that if things did get worse rather than better, someone else has asked, do you think oil prices could hit $200 a barrel, and what would be the impact of such a significant spike? So. I appreciate you haven't got a crystal ball, but yeah, if any thoughts, I
So
guess,
let's
on that
start
sort
with
of thing.
the second question. Yes, the markets are currently not pricing in that we will have the Strait of Hormuz being blocked for more than a couple of weeks. If the Strait of Hormuz was blocked for longer, we could see higher oil prices. And indeed, after what we saw last weekend, them all of a sudden shooting up to $120 before coming back down, there's no reason why in such an environment they couldn't briefly shoot up to $200 or $250 even. Um, what we need to recognize, though, is also what I said early on, which is A, we went into this whole situation with a surplus of supply rather than a tight supply environment. And we're currently, there's about 20 million barrels of oil that are not going through the Strait of Hormuz at the moment. But human ingenuity, when risks arise, tends to find ways around it. Unfortunately, that currently would play into Putin's hands because he's sitting on a lot of surplus oil that he hasn't been able to sell. Um, Apparently, up to 60 million barrels are currently just idling in tankers, in Russian charter tankers, waiting to be unloaded. And it is well possible that that is going to ease some short-term restrictions. What that does to the Ukraine war is a different matter. But I think just because something happens in the shorter term, it would pretty wrong to assume that it all goes down just in one straight trajectory. Um, that was the taco trade and the tour. And what was the first question again? Remind me.
Well, it was just saying that do we think markets are underestimating the potential for a longer shock because the taco effect that they've seen of Trump backing away, and actually that the chance that he might not back away is actually possibly higher.
Well, they're currently not pricing it in. Whether that is underestimating it or correctly pricing it is a different question.
Mm,
We know that the Teco trade still works. He already got quite bored of his war, declaring, wanting almost to declare victory long before it actually has happened. Can he extract himself quite as quickly out of it as he got himself into it? Maybe not.
mm,
But then equally, the world isn't going to come down just because of oil prices being at a higher level for a couple of weeks, while the global economy is going at a relatively strong tech and these days is far less dependent overall just on the Middle Eastern oil than it was in the 1970s. That having said that, India, China, South Korea are hugely dependent on oil from the Middle East, and they would have to find other sources, just as Europe had to find other sources when the Russians turned off the gas. And as we saw, that can be done, and it usually is done if the price is right. As I said, this is one of the headwinds, but I'm currently almost more concerned about the credit crunch that is going on at the lower end of the corporate spectrum, as well as, not the global markets at the moment and investors musing around what will happen, how will AI actually really pan out for the
mm.
global economy? Will it all be just one positive improvement of productivity? Or will we see quite a bit of dislocation before we see the benefit? So those things are still there in the background, but have been completely muffled by the big noises of that war that was started in the Middle East.
Yeah.
I
And I
mean,
think your earlier point about the Iranian economy being dependent on the oil exports, so yeah, they must be, yes, some strong desire to seek a resolution as well from that perspective. Hopefully, hopefully, sort of help shorten the end of the conflict.
indeed, indeed.
I had a question about AI actually. We've had in advance did have several questions around gold and precious metals, but I think you've covered those sufficiently in the session. A question around AI that's come in though is around AI's impacts on global employment and whether ultimately the advance of AI might be deflationary over the long term.
Uh, yes, indeed. It may well be. I think, and I should have mentioned the other deflationary impact earlier as well. So at the moment, everybody thinks that higher oil prices will be inflationary, but indeed, if it slows down economic growth that has been in the pipeline, then it could actually be that in the second half of this year, we've got less inflationary pressures than we're currently fearing, just because the rest of the economy has slowed down somewhat. So it's sort of a double-edged sword. Um, is AI going to be inflationary, deflationary? Well, at the moment, it looks like it's holding itself each other in balance because the massive investments that are going in are actually fanning inflation in certain areas. The mega scalers, the hyperscalers in the US have to spend more and more for the same piece of data center, for example. That is clearly inflationary. Whereas we see the efficiency improvements in other areas really putting a bit of a lid on costs and also the labor market. So it is possible, although those scenarios were perhaps a little bit overcooked, that came out just before the war kicked off, that there could be mass unemployment because of AI. Because we have to recognize that while AI is a very, very strong tool, it is difficult for it to really completely replace human beings. As we describe it in our business, it's like having a very competent and desk assistant who has got infinite time to do jobs for you, but it's still a desk assistant, and you are responsible for their output. And guess what? Their output is not always right. You have to be mindful of that, and therefore, at the moment, I'm worried. I would be concerned about some sectors like call centers, for example, where it's been shown that uh, AI-driven chatbots, and this is not written, this is actually speaking to you, are very, very good at replacing lower skilled operators in call centers. And that's particularly a problem probably for India and Malaysia going forward. But other than that, our experience is always when these technologies take hold, they actually lead to more activity, not less activity. And therefore, yes, we need to think about what we perhaps do sometimes with the resource that then becomes available. But I can tell you at the moment, at least in our business, our three coders are jolly happy that they don't have to code a single line of basic code anymore and can design the software, which we wouldn't be able to, rather than having to write it from scratch. And all of a sudden, my waiting for improvements in our system has gone from half a year to maybe 6 weeks. And that is actually really, really nice to see how we can all of a sudden generate things and progress a lot faster.
Excellent. Good. One final question before we let you go and have your hot lemon and honey later. And this is, I guess, a bit more of an investment process question. And I think it'd be good for clients to understand. It's how quickly and to what extent can you change portfolios in the event that your views change? And obviously, yeah, I guess that's both short-term views and longer-term views.
Well, so in theory, we can change it very quickly in a day, because with the overlay funds that are in clients' portfolios, we can just do that without even having to touch every single client's portfolio and go through a rebalance. The bigger question is how advisable it is to do those changes very, very rapidly. Yes, sometimes opportunities arise. So we were able to increase our bond exposure during the Liz Truss sell-off, for example, because we just could see that that wasn't going to last. But those opportunities don't actually open themselves up quite so often. And oftentimes, what I hear from clients is, oh, surely you'll be able to just move all the risk exposed assets into cash just before the crash happens and then put it back in when the crash is at the bottom. And my clear answer to that is absolutely not. Because that is exactly how you are likely to lose money rather than gain money, because moving into cash might be very easy, and it indeed is very easy, but spotting the bottom and putting it back into the markets is extremely difficult. So we tend to be more moving the portfolios into the markets when we think we've hit the bottom. We did that in March 2020, early April 2020. And we are in the process of doing it at the moment as well. So we've got various trades lined up that, depending on how far markets go down, we will deploy to build risk positions from a lower level. You know, just yeah, basically, to quote Warren Buffett, we all like to purchase things at a discount, whether it's stocks or stocks. They're definitely better value when they are trading at a discount. We don't see big discounts yet, but when they are there, we'll be there.
Excellent. Yeah, and as you say, those overlay funds give you that flexibility, which is very good. And one of the reasons we really like your investment style and think it's good for our clients. Excellent. Well, we've overrun as usual, and yeah, you're both certainly suffering a little bit with a seasonal cold. So let's wrap up there. Just want to thank everyone on the call for taking the time to listen. I hope they found the session useful and insightful. I certainly did. If anyone does have any further questions, they can please get in touch with us. Get in touch with your usual SG Wealth contacts. We'll be happy to discuss them with you. And just as a reminder, there will be a feedback questionnaire sent out when the webinar closes to provide feedback on today's session and also ask about any other topics you want to see covered in the future. So I guess without further ado, thanks again, Lothar. Really appreciate your time. And we look forward to seeing everyone on the call again soon. Many
Thank
thanks.
you, Henry. Thank you. Bye bye.